Imagine waking up to a life where your money works for you, where the jingle of loose change is replaced by the rewarding sound of dividends flowing into your account. Envision a world where financial freedom isn't just a concept, but a real and attainable way of life. This isn't some distant fantasy. It's well within your reach. Just as a comfortable retirement looks different for everyone, there are countless financial paths to consider. Some people explore reverse mortgages, sell off assets, or relocate to more affordable places. But there's another strategy that often gets overlooked: living off investment dividends, a method that can help you earn $2,900 a month. Stay with us, because we're about to reveal 3 fast and powerful ways to reach that goal. So what's the secret formula for determining your ideal investment amount? It all comes down to your desired lifestyle, and of course, the numbers behind it. Sure, the average person spends around $67,000 a year, but that may not be the right benchmark for you. You can tailor it based on your personal needs, ambitions, and comfort level. Now, let's add a touch of intrigue. Imagine this: a life where your investments generate a steady stream of income, allowing you to enjoy the rewards of your hard work without ever touching your principal. It's like having a hidden money tree that continues to grow and sustain you through passive dividends. The possibilities become truly enticing. This journey is all about finding the balance that aligns with your dreams. So take a moment to envision your future. Picture the lifestyle you aspire to, and let the numbers guide you toward the investment amount that will turn dividends into your path to financial freedom. In this video, we'll show you and Mark exactly how to reach the goal of $2,900 per month, or $35,000 per year. Before we move forward, let's understand what dividends are and how they work. Imagine becoming a part owner of a company simply by purchasing its stock. When that company earns a profit, it has several choices on how to use it. It can reinvest the profit to grow the business, or it can share a portion of it with its owners. In publicly traded companies, those owners are the shareholders, people like Mark. If a company chooses to distribute part of its profit to shareholders, that payment is called a dividend. As a shareholder, John would receive a portion of that profit based on the number of shares he owns. Dividends can be paid in cash, either through digital deposit or by check, or automatically reinvested into additional shares of the company's stock. While companies follow different dividend schedules, many choose to pay them quarterly. Now, let's talk about dividend yield, a simple yet powerful way to measure how much income you're earning from dividends compared to the price of the stock. Dividend yield can vary widely from one company to another and may even fluctuate for the same company over time. Generally, well-established companies tend to offer higher dividend yields than smaller or newer ones. Calculating dividend yield is straightforward. You take the annual dividend per share and divide it by the current price per share. For example, if Mark owns a stock priced at $100 per share and receives $10 in dividends per year, then his dividend yield is 10%. Understanding dividend yield allows Mark to evaluate his investments more effectively. He can compare different stocks, identify which ones align with his financial goals, and choose options that match the level of risk he's comfortable taking. By investing in dividend-paying stocks, Mark has the opportunity to earn consistent income without ever needing to sell his shares. This means he can enjoy a steady cash flow while keeping his investment intact, which is pretty remarkable. So for Mark and anyone else looking to earn passive income, dividends can be a powerful and attractive strategy. It's a way to grow your wealth steadily and eventually live off the returns generated by your investments. Now, let's take a closer look at 3 simple strategies that can help Mark reach his goal of earning $2,900 per month, or $35,000 per year in dividend income. Strategy 1: Covered call ETFs. One of the fastest ways to generate consistent dividend income is by investing in covered call ETFs. These specialized funds allow investors to earn income from both stock appreciation and option premiums, which are paid out as dividends. How does this strategy work? A covered call ETF buys a basket of stocks and then writes, sells, call options on those same stocks to produce additional income. A call option gives the buyer the right, but not the obligation, to purchase a stock at a predetermined price within a specific time frame. When the ETF sells these call options, it collects premium income, which is distributed to investors as dividends. Furthermore, if a stock's price rises above the option's strike price, the ETF may realize capital gains, as it will have to sell the shares at that higher price. This combination of option premiums and potential gains makes covered call ETFs an attractive income-generating tool. There are several popular covered call ETFs worth considering, such as XYLD, OILK, and EWZ. These funds offer highly attractive yields, often in the double digits, which are significantly higher than those of many traditional dividend stocks. Let's take a look at their 12-month trailing yields. XYLD delivers a yield of 11.83%, OILK provides 11.82%, and EWZ offers 11.81%. The advantage of these ETFs lies in their ability to generate income from both dividends and option premiums, creating a more stable and consistent stream of passive income. However, it's important to recognize the associated risks. For example, options may expire worthless, and declines in the underlying stock prices can negatively affect overall performance. Now, let's apply this strategy to Mark's journey. If Mark aims to earn $2,900 per month, equivalent to $35,000 per year through covered call ETFs, we can adjust the calculations accordingly. Based on current yield levels, Mark would need an investment of approximately $280,000 to $310,000. That's quite impressive, isn't it? Especially when compared to traditional dividend stocks, where he would need nearly $2 million invested to generate the same level of income. By choosing covered call ETFs, Mark can reach his financial goal of earning $35,000 per year, or $2,900 per month, without requiring an excessive amount of capital. This strategy provides an opportunity to build a steady and reliable income stream while significantly reducing the investment needed. If Mark is ready to take this step, exploring covered call ETFs could be a powerful way for him to pursue his dream of living off dividends and achieving true financial independence. Let's explore another strategy for Mark to earn $35,000 per year, or $2,900 per month, through dividends. This approach involves investing in specialized companies known as real estate investment trusts, or REITs. Strategy number 2, high-yield REITs. REITs function like large teams that invest in real estate assets such as shopping malls, office buildings, and residential apartments. These companies generate income from their properties and distribute a portion of that earnings to their shareholders. For Mark, several high-yield REITs stand out as strong candidates for earning passive dividend income. These include Two Harbors Investment Corporation, offering a dividend yield of 20.3%, Brandywine Realty Trust with a dividend yield of 19.9%, Orchid Island Capital Incorporated, providing a dividend yield of 19.4%. These REITs have a history of delivering reliable dividend payments to their investors. Historically, REITs have demonstrated solid overall performance, with an average annual return of 10.8% over the past 20 years. This indicates that investing in REITs can be a smart and effective way for Mark to grow his wealth while enjoying a consistent stream of income. It's important to understand that the income you receive from REITs can fluctuate because it depends on factors such as occupancy rates, rental demand, and overall economic conditions. While REITs often provide higher yields compared to regular stocks, they also carry greater risk during periods of economic downturn. So, how much does Mark need to invest to earn $35,000 per year from REIT dividends? If he expects an average annual return of 10.8%, he would need to invest approximately $320,000. However, this amount can vary depending on whether he diversifies across multiple REITs or concentrates his investment in a single one. A practical approach for Mark to retire using REIT income is to save and invest consistently each week, allowing the dividends to compound over time until he reaches his target. With discipline and patience, he could achieve financial independence in 5 to 7 years. When investing for dividend income, it's essential for Mark to have a clear plan. He needs to understand how much income he requires and what his long-term goals are. This clarity will help him choose the most suitable REITs for his portfolio and stay committed to his strategy over time. Everyone's financial situation is unique. Mark may discover that he can live comfortably on less than $35,000 per year, or he may need more depending on factors such as family responsibilities or lifestyle preferences. One major advantage of REITs is that, unlike most traditional stocks, they often pay monthly dividends, making them especially appealing for investors seeking a steady, reliable income stream from the market. By adopting a thoughtful REIT-based strategy, Mark can work toward his financial goal of earning $35,000 per year, or $2,900 per month, in dividend income. This approach could transform his dream of living off dividends into a practical reality. If Mark is ready to take the next step toward financial independence, exploring the world of REITs is a smart and strategic decision. It's an investment path with real potential to turn his goals into reality. Strategy number 3. Dividend aristocrats. Dividend aristocrats are a special category of stocks within the S&P 500 index. These companies have an exceptional track record. They have increased their dividend payments to shareholders for at least 25 consecutive years. Because of this consistency, they are considered excellent options for investors seeking reliable income. Some well-known dividend aristocrats include 3M, Leggett & Platt, and Walgreens Boots Alliance. On average, these companies offer a dividend yield of around 7%. While this is lower than the yields typically provided by covered call ETFs or REITs, dividend aristocrats are highly valued for their long-term stability and dependable payouts. To qualify as a dividend aristocrat, a company must raise its dividend every single year for at least 25 years. Whether investing in these stocks is right for you depends on your goals, your investment timeline, and your risk tolerance. Although dividend aristocrats come from a wide range of industries, they share several important characteristics. In addition to consistently increasing their dividends, they are well-established, financially strong companies that have demonstrated steady growth over time. They are usually large, mature businesses that are less likely to be acquired, and they often perform better during challenging economic periods, allowing them to maintain stable profits and continue rewarding investors. So, how much does Mark need to invest to reach his goal of earning $2,900 per month from dividends? Assuming an average dividend yield of 7%, Mark would need to invest approximately $500,000 to become fully financially independent. Although this may seem like a substantial amount, it is still far less than what he would need with traditional dividend stocks, where achieving the same payout might require an investment of nearly $2 million. In comparison, dividend aristocrats offer a far more accessible path to the same income level. A smart approach for Mark is to diversify his investments across multiple dividend aristocrats. This helps reduce risk while maintaining a steady flow of dividend income. These companies have a long-standing history of raising dividends consistently, and their inclusion in the S&P 500 index further reinforces their stability and credibility. By investing in dividend aristocrats, Mark positions himself to receive reliable, long-term income while benefiting from the strength and proven performance of some of the most dependable companies in the market. Unsure where to find the best investment opportunities for generating steady income? Watch our upcoming video on the channel and fast-track your dividend income goals with simple, expert guidance. Subscribe to our channel to stay updated and never miss a new strategy that can help you grow your wealth.